Hey, how's everybody doing? It's Jordan Dove. Harley's in the office working on some real estate business. I want to say hi to everybody
Hello,
today.
everybody.
So she's going to sit next to me while I go through our Monday market polls where we discuss the U.S. housing and economic update for the week of March 20th, 2023. We have some interesting information to discuss today, but first I wanted to send a very special thank you and shout out to all of our clients who have trusted us and supported our business, our friends and family and colleagues who have referred us business over the many years we've been doing this. I saw a lot of old photos pop up on my social media feeds of previous clients, and I just wanted to say thank you to everybody. We really love what we do, and we really appreciate your support. Okay, so without further ado, let's get into the review of last week, and it was a pretty roller coaster kind of week. It was volatile on Wall Street. Traders put their money into the big names far away from the banking sector, but it pushed the S&P 500 and NASDAQ up nicely while the Dow slipped only a tick. Investors, they were concerned about the recent bank failures, but many of them took comfort in the swift action by the Fed, the Treasury, and the FDIC to support depositors and quell the fears that could potentially cause a bank run, which we have not seen happen. But what we have seen is a lot of investors and people who are holding money in the smaller banks move them to larger banks. As I was just watching CNBC, and JP Morgan has had an influx of accounts and money move in to them. So it looks like the big banks are going to be taking over these smaller banks, which I do not think is going to be a good thing. But hey, what else is not monopolized in this country already? Now, we did get a weaker than expected retail sales in February, but the CPI inflation fell to 6%. That's the smallest annual increase since September of 2021, while initial jobless claims sank back below 200,000. Last week, the week ended with the Dow Jones Industrial Average down 0.1%, the S&P 500 up 1.4%, and the Nasdaq up 4.4% to 11,631. And bonds, they made overall strong gains. The UMBS 5.5% up $1.08 in the last 2 weeks, just north of $100 now, sitting at $100.29. The national average 30-year fixed mortgage rate headed down in Freddie Mac's primary mortgage market survey. But guys, you got to remember that mortgage rates are extremely volatile, so check with your mortgage professional like Chuck Barone for up-to-the-date minute information. Treasury yields have been sinking. That 10-year bond yield has sunk, and I think rates are going to continue to follow, at least for the time being. Now let's move into our national housing update. So for the first time in 6 months, housing starts, which is builders building new homes, it shot up 9.8% in February, with both single family and multi-unit projects posting gains. Building permits did even better, up 13.8%. That's the largest monthly gain in 2 years. So to break down the new residential construction numbers for February, there was 1.524 million building permits, 1.45 million housing starts, 1.557 million housing completions, and the next release for March will be April 18th, 2023. So we will make sure you guys are updated with that information. So please like and subscribe to the channel so you guys know exactly what is going on in the national housing market. So with that being said, home builders are clearly feeling more optimistic. The Home Builder Sentiment Index headed up for the third straight month, indicating the housing market is starting to find its footing in the present mortgage rate environment. Now, new construction has had a significant amount of inventory, somewhere around the 9 to 10 month range on a national level, whereas in resale markets, many still sitting below that 6 month even buyers sellers market. In our market, inventory is actually decreasing. Resale inventory, we're down to about a 2.2 month supply, which is very low, and the absorption rate figure has shot up to 40%. That means if no more properties were to come on the market, we would be able to sell everything in our entire market in about 10 to 11 weeks. That's a low number. Sales have picked back up. Pending sales have picked back up. Closings are on the rise. So what's happening nationally with inventory rising is not happening here in Las Vegas with inventory decreasing. Anyways, Realtor.com is reporting active inventory keeps climbing, up 61% from a year ago, but that is a national number. I just told you in Vegas it's declining. It's been declining for months in a row now. Anyways, back to national housing. Homes are spending more time on the market than last year, but they're still selling quicker than before the pandemic, which is suggesting that we're continuing to see buyer demand. So to have some data summary for you, I'll put the chart up on the screen for you. All changes are year over year. The median listing prices are up 8.1% year to date, and for the week ending February 18th, 2023, up 6.5%. New listings are down 16% year to date, and for the week ending February 18th, they're down 18%. But year to date, active listings are up 66% and 67% respectively for the week ending February 18th. The time on the market is 17 days slower and 24 days slower respectively. A little bit of housing trends. This is for the week ending March 4th, 2023 with the year-over-year change. Median listing prices up 6.3%. New listings are down 26%. Active listings up 26%. That means they're sitting on the market longer. And that year-over-year change for time on the market, homes are sitting on the market 18 days on average across the country. And a little did you know to end this segment is Freddie Mac notes that turbulence in the financial markets is putting significant downward pressure on rates, which is sparking some buyer demand. Last week, purchase mortgage applications rose a seasonally adjusted 7%. So that's our national housing portion. We're going to move into the economic notes, just some highlights to discuss what's going on in the economy. The Fed is poised to approve a quarter-point rate hike this week despite the market turmoil. So the Fed, they're likely going to approve a quarter percentage point interest rate increase this week. That's according to how the market is pricing it in and according to many Wall Street experts. A rate increase would come just a week after other regulators rolled out an emergency lending facility to halt a crisis of confidence in the banking industry. And I quote from Mark Zandi, the chief economist over at Moody's, this might be one of those times where there's a difference between what they should do and what I think they will do. They definitely should not tighten policy. So we're going to see what happens March 22nd. The meeting starts tomorrow, but the decision will come out on the 22nd. A giant behemoth Wall Street bank Goldman Sachs cuts the growth domestic product forecast because of the stress on the small banks, which is key to the United States economy. So what happened was Goldman Sachs lowered its growth forecast by 0.3 of a percentage point to 1.2% for the year of 2023 as gauged by the fourth quarter of 2022 to the fourth quarter of this year. Analysts believe a pullback in lending will lead to substantial tightening in bank lending standards, dragging down growth already affected by tightening in recent quarters. And banks with less than $250 billion in assets comprise about 50% of U.S. commercial and industrial lending. So what's really interesting about that is the Dodd-Frank bill that passed. Trump made a modification to it where banks under less than $250 billion did not have to do these certain things and regulatory things that the bigger banks had to do, which is setting up to be a perfect storm for the big banks to absorb the smaller banks so you have less banking choices. Really want to watch that closely and see what happens. Moving on to another note, the inflation gauge increased 0.4% in February as expected and up 6% from a year ago. So we still are facing inflation. The consumer price index rose 0.4% in February and 6% from a year ago, and that was in line with the market expectations. A drop in energy prices helped keep inflation in check while shelter costs increased sharply. In our market, our gas bills have absolutely skyrocketed. In February of 2022, our gas bill was $56. In February of 2023, it was $256. So I don't know where that drop in energy prices are actually coming from. And in our market, rental prices are actually starting to come down. Now, the probability that the Fed would raise the benchmark interest rates a 1/4 percentage point, that increased after this report was released. And as you guys know, we're always watching the Treasury bond yields. Bond yields are up today, but they are down significantly over the last week or so. The U.S. 2-year Treasury bond yields just south of 4 at 3.966. The 5-year at 3.594. The important 10-year, which closely correlates 30-year fixed mortgages, at 3.492%, and the 30-year long term at 3.669%. All right. Quickly into the Las Vegas section. Median housing prices, not much has changed since February. Single families at $425 so far for the month. Condos at $225. That's up almost $5,000 from February. And townhomes at $318,000 median. That's up $8,500 from February, from that number of $309,500, and that's based on 1,607 sold listings on the MLS as of March 20th, 2023. All right. The predictions that we have this week for you guys is the reports on the February housing market are expected to show existing home sales on the rebound, but new home sales flat or posting a small decline. The biggest focus will be on Wednesday's FOMC rate decision, which is just 2 days from now. The Fed is expected to hike just a 1/4 percent, though we could see the central bankers take a pause. What do you guys think is going to happen? I really think they should raise 50 basis points, but I think a 1/4 is in the cards. Now, time for our real estate tip of the week, and here is why the housing market isn't going to crash. Yes, it has been correcting, but I do not believe, in my opinion, that we are going to see a crash like we did in 2008, where there was an absolute fire sale and you were able to buy homes for $30, $40 a square foot in major markets. Now, today's market is different than it was in 2008. It used to be extremely easy to qualify for a home loan. You could say, hey, I make $1 million a year. They're like, great, sign this paper, go buy 5 houses. But today, lending standards, they've tightened significantly, so today's buyers are well more qualified. As a result, the number of foreclosures has significantly declined over time. Although we have seen a slight increase in foreclosures pick up, it is still well below the numbers between 2007 and 2010. Now, another reason, at the same time, there is an undersupply of homes available for sale today, which helps keeps prices from crashing. Back in 2010, we had 9.4 months supply of homes. In 2009, we had 8.8 months supply. In 2008, we had 10.4. In 2007, we had 8.9. Well, let's fast forward to pre-pandemic. We had 3.9 months supply of homes available on the market. In 2020, 3.1. 2021 was a crazy ass year. We had 2.3 months of inventory, and now at the end of 2022, 2.7 months of inventory. Today, we have 3.1 months of inventory on a national level. And home price gains have resulted in near record amounts of equity, and that puts homeowners in a much stronger position. So if you were in trouble, you could list your home, actually walk away with some money instead of being underwater and having to short sell it and walk away with nothing. Now, the total U.S. homeowner equity in trillions of dollars from 2007 to 2022 was we had about $1.3 trillion of homeowner equity in 2007 to now $3.1 trillion in U.S. homeowner equity. That is a ton of money in form of equity. So if you're concerned about a crash, let's discuss why this isn't like the last time, you guys can reach out to me or Harley. My contact information is in the video. Now, watching the Federal Reserve, we're forecasting Federal Reserve policy changes in the coming months. Now, given the recent news around banking, Wall Street feels that we're now only going to see a 0.25% rate hike this week, none in May, and then a rate cut in June. So Wall Street is forecasting a rate cut in June. I don't know if that's going to happen. I might be a pause. I think they would pause for several months before they did a rate cut, but there is a consensus, a 73.8% consensus, that after the FOMC meeting this Wednesday, that rates will go up 25 basis points. There's an 88% consensus after the May 3rd Federal Open Market Committee meeting that there will be a pause, 88%. And then on June 14th, there's a 50% consensus that they will actually do a decrease in the overnight Fed funds rate. So that's the market report, guys. We gave you what's going on in the economy, the national housing, touched on Vegas a little bit. The best deals in real estate right now, I have to be honest with you, they're in new construction. They have a 9-10 month supply. Go use their lender. Go get all the upgrades. Get your closing costs paid for. We're going to buy down your rate for 30 years into the four, so that payment's much more affordable. And then when the market goes up, sell the house and then go find a great resale deal. Whatever you want to do. But if I was in the market to buy a home right now, I would definitely consider new construction. We can help you guys with that all across the country. Just reach out if you'd like to work with us. I hope everyone's doing well. Share this video with somebody who may be uneducated on what's going on in the economy and the housing market. And until next time, I will see you later.
We'll see you later.
See you guys. Have a good one.
No?